Welcome to the HART Investment Group semi-annual review. I'm Scott Goodfeldt. This is Ben Hart.
Hello, hello.
Uh, yeah, twice a year, Ben likes to put a nice video together, a slideshow about, what's gone on in the markets, what's worked, what hasn't. Um, Talk a little bit about what's going on in the market. So here we are.
Here we are. It's been an interesting year for sure. We've
Interesting year,
yeah, I think
that's for sure.
we've covered a lot of things on the podcast this year. We've definitely been busy trying to cover as many highlights as we can. I was just at a soccer event with my daughter, and the parents were talking about some of the things that we've done and talked about, and liked how diverse the podcast has been in the first half. But this one's going to be much more focused around the macro and the individual positioning, and I think it's just a good check-in as I've spoken with clients over the past couple of weeks. It's important to say, let's revisit some of the things that we talked about earlier in the year and see if they're working and they're playing out as I expected. And if they are, great. If they're not, why not? So this is a chance to go through some of that today.
All right, so I guess that means fewer jokes on my part, right? We got to keep it serious. Ben's gonna talk about the world and the economy, so let's keep it serious, Ben. So let's start with exactly what we're here for. What's worked and what hasn't? That's what we'll call this segment.
Yeah.
So Ben, what has worked and what has not worked?
Yeah, so the first two quarters of the year were quite different. That Q1, when I look back at the annual presentation we did early this year, there's a couple of things that I'd comment. And point one was, I thought commodities should do well through the first half of this year, and commodities kind of struggled out of the gate, and then started to work, and kind of we'll say March, April, started to go up. Same with Bitcoin and Ethereum. The cryptos ripped out of the gate. Like that first 3 months was great and explosive, and we had a nice return profile right out of the gate. And so a lot of those things that I'd put out into kind of the early section of what I thought could work, a lot of those things worked really well for the first quarter, and then we had reasonable change to the market landscape. So commodities did well, Bitcoin and Ethereum did well Q1 and had a horrible Q2. So it kind of gave back a big chunk of that return. The other couple of places that I thought would do well kind of coming into this year was tech, consumer discretionary, and inflation-linked bonds. So those are kind of the core areas that I thought would do well, and most of them actually performed reasonably well year to date. But that one surprise was kind of mid-March, and if we look back to that, mid-March we saw the U.S. 10-year go up to the kind of the 170, 176 level, and that really changed the dynamic of what was working and what wasn't. And so, pressure came with crypto, small caps, tech. All those things had a pretty choppy April, May, and May was really kind of a bad month for anything kind of a little bit higher risky, like small caps and technology and crypto. So what worked? Commodities, what worked, and consumer discretionary and energy. Those were probably the best places in the portfolio. So I'd say that's worked the best. Obviously, everyone in all my calls want to talk about what didn't work, so that's probably where I spend quite a bit of time from a conversation perspective. Everyone wants to know about that one stock that didn't do well.
Yeah, exactly. Yeah, I mean, even with crypto, right? I mean, the way that it was trending and the way the amount of publicity it was getting, everybody thought it was just going to keep going to the moon, right?
Yeah,
Um,
yeah,
so it was easy to get caught up into that, and like you said, huge returns in the first what was it, first
first quarter.
quarter, and
Yeah.
then, like you said, it was a bit of a shocker in the second quarter. That do you think were you shocked that it fell as hard as it did?
The timing of it surprised me. So my kind of
Yeah.
view was that, we would get that sell-off in crypto when we got the sell-off in broad equities, and it really didn't play out that way. So I expected crypto to sell off kind of in the second half of the year when I expect equity markets to sell off. So I was surprised at that, but I mean the amount of leverage, I guess, that came into the system, and the speed at which it happened was really fast. But it's an important reminder of how much volatility there is in the space. And I started trimming Bitcoin in December last year and trimmed and trimmed and trimmed. Obviously, from a learning perspective, you want to be perfect on when you're trading, but you can't be perfect. So we did reduce risk over the quarter, but certainly didn't bring it to zero because I wasn't expecting that sell-off to happen as quickly as it did.
Do you think it's also a start of the trend in the market? Like the speed of the
Mm.
market has really
Mm.
escalated, right? I think we're going to see, you know, these huge swings faster than we ever did before. Is that what you think as well?
Yeah, so that's a great question and a great point. This was the year of the meme stock, right? So as we saw GameStop and AMC and a number of other names kind of grab that attention, and so you see, 1,000% returns in stocks, which I've, only ever seen in the tech heyday, and it was for a different reason. So yeah, the speed at which things change is way higher. We had electric vehicles as well go up and do quite well. And some of these things are down 80% for this year. So
Mm.
yeah, typically something like that happens over a longer period of time. But I think you're right, the speed changes quickly. A lot of that's momentum based. A lot of that is kind of ETFs, fund flows. So a lot of the things that historically looked at, fundamentals, valuations, these kind of things that you could project over a period of time.
Hmm.
Certainly, this first year has shown us that that might not be the case. That you need to move quickly.
Yeah. I think it's probably not a coincidence either that we're seeing record highs in retail trading, right? People discount trading, like they're buying stocks with, you know, just buying those momentums, not really knowing anything about the companies at all, right?
Yeah, and we've seen massive leverage. So Robinhood filed for their IPO, so they announced where their revenue comes from. And
Hmm.
the majority of their revenues, I think 400 million in the first quarter of this year, came from options trading. And so you
Mm.
get like massive retail, like that's retail that's trading that. And so that
Yeah.
is, that's as gambling as you get.
Yeah.
So
Yeah.
yeah, retail speculation has certainly driven directional trading that is again completely irrelevant to the underlying business.
Yeah, for sure. I don't think that's going to go away either unless there becomes some sort of regulation on it, right? Because we've talked about before, I think, you know, the appetite for, you know, that long-term buy and hold for the younger generation just won't be there. People want massive returns now,
Hmm.
so I think they're going to lever up and, you know, shoot their shot and you know, want those massive returns right away. They're not going to want to wait that those 10 years, 5 or 10 years, or however long the play is, right? So I think we're going to continue to see those type of things.
Yeah, so I think that's why it's definitely important for our process to continue to evolve, and why I spend the time looking for external research providers that can give us good information, because we can't access fund flows information like they do at speed. So, part of why we subscribe to Hedgeye is Hedgeye has a computer that kicks us out data that can help you interpret what's happening in real time. So, you get oversold signals, you get overbought signals, you get information at very high speeds, and that's all done by a computer because obviously a person can't interpret this data at scale.
Yeah,
So I think
yeah.
it's important to continue to evolve that process.
All right. Well, do you want to get into the slideshow or what?
Well, I think maybe we just talk. We can just talk as we go here instead of pulling the individual points. I might show a couple of slides here, but I think we can talk through it if you're good. If you think that makes sense.
Oh yeah, for
Yeah.
sure. My bad. I thought we were showing it.
Yeah,
Okay, no
we
problem.
could. I think we can just. I'll just refer to them as points, and so,
Yeah.
I think that the one section we didn't talk about too much that didn't work, and I think that probably the thing that surprised me the most would have been the weakness in the U.S. dollar. And so, I guess from a learning perspective, you had commodities doing well, and massive amount of money coming into the system. So you had U.S. dollar weakness, where I expected the U.S. dollar to be weak. I didn't expect the severity of the weakness in the first half. And so that caught me a little bit more off guard than I would have expected. Some of that's reversed here in the last couple of weeks, and U.S. dollar strengthened again. I think the bond move as well was a bit of a surprise. So, U.S. 10-year went to 176. It was the worst start in bonds for 30 years. So the steepness of how quickly that move came surprised me a little. So, these are all things that you do to look at and make sure you're thinking about some of these risks as you continue to move ahead. Again, some of these things are reverse. Bonds have started to do well again. U.S. dollar well again, but those were probably the two things that surprised me the most in the first half that had a negative impact on portfolios.
Okay.
So I think
I have nothing to add to that. Agreed.
That's fair.
Also surprised. What's next?
Yeah, I guess from a observation perspective, I put it back to you. What have you felt and heard from clients? I'd say in the last couple of months. I know you've had some good conversations with clients over the last couple of weeks. Anyways, anyone asking about anything specific that I didn't touch on market wise?
No, I don't think so. I mean, I would say the thing that we hear the most about or have in the first half has been crypto, right? Because the new people wondering what it is,
Yeah.
right? So you obviously touched on that. Um, yeah, I don't know that there is anything else that you didn't touch on. Nothing specific that comes to
Yeah,
mind.
fair enough. I mean, I think the only other question that think seems to come back to us sometimes is just about cash. Why do you have cash in portfolios instead of it being fully invested? So,
That is very
yeah,
true. That is, we do hear that. I do hear that a
yeah,
lot. You got me.
yeah, no,
You
no.
got me.
So I think that I think from a positive perspective, when I look at it, the cash typically was there in lieu of bonds. So had you had overweight bonds in the first half of the year, you would have got your portfolio beat up pretty hard. So instead of doing that, they were sitting in cash, but now starting to put a lot of that cash to work and deploy it. And so
Yeah.
I'd expect cash values to be quite different in the back half of this year. And
Yeah.
additionally to, I've moved some of that cash into Swiss francs and Japanese yen. And so some of these other currencies do well with the back half of the year, what my view is. So, I think probably the next section
Mhm.
would be, what do I expect to happen in the second half? And, you know, uh, that was kind of the last thing that I get questions about. I know you've mentioned that you've had a
Yeah.
few as well.
Yeah, just to expand on that. So is there any situation where if people see cat like is there an advantage to having cash like sitting in a cash position versus having it all invested? I mean,
Yeah,
when people call or email us and
sure.
say it's usually like, "Hey, how come my money's not invested?"
Right.
Is there a situation where that's part of the strategy or is it just we haven't moved it all in yet?
Yeah. So no, that's a great point and a good question. When I look at the asset mix of clients' portfolios, we come to an assessment around how much we think they should have in bonds, we'll say within a portfolio. So say you want to have somebody with 20% bonds, 80% stocks. That's the current risk profile for them. So I would look at it and say, okay, I have a 20% allocation that I can put towards something fixed income related. And so if I had 20% in government bonds in the first half of this year, that 20% of my money would have lost about 6.5%. So if that 20% of my money was sitting in cash, obviously you wouldn't have made much. It would have kind of just been stable, but you would have protected your principal versus being invested in bonds. And so,
Right.
oftentimes people say, well, why don't you just put that money into stocks? Well, that dramatically changes your risk profile. And so, the conversation that people don't understand is that, moving from cash to stocks, like that's a big change in your risk, where many people
Yeah.
just look at it as the same thing. Well, why don't I just buy a stock with the cash? Well, you're
Yeah.
increasing your risk by 50%.
Yeah.
Yeah,
Exactly. And we just don't want to buy stuff for the sake of
that's
buying
right.
it, too,
Yeah,
right? Like we want to, you got to time it. You're trying to time it correctly, and you know, buy what's right. So that makes a lot of sense. Yeah, that's probably the biggest questions that we get.
yeah,
So
for sure.
stop asking us about your cash.
We're making it work.
No, I'm kidding. You can ask as many times as you want. We'll certainly help you out.
Yes,
Just joking.
yes.
Uh, but stop. Okay. Uh, okay. What did you say was next? We were going to talk about
Yeah, so I guess
what's next
the
exactly.
second half of the year, and so I think that's in when I look at the annual presentation that I did in January. There's a few things that I expected to do well in the second half of this year, and those are some of the things that didn't do well in the first half. So I expect the U.S. dollar to do well over the next 3 to 6 months, and so that was the top thing I put out at the start of this year. I still believe that to be the case. Puts,
Mm,
which I'd said in my presentation start of this year at some point I'd start buying index puts, and I know I said we were going to do a video on this and try to simplify it, and we haven't done that yet, but that'll be something we'll do for sure in the second half.
we haven't figured out how to
Yeah,
simplify it.
exactly. So I've tried to have that. I've had that conversation multiple times, but it's fire insurance. It's that small amount of money you put into the event that a fire occurs, and I expect the S&P to be down somewhere between 10 and 20% in the next half of the year. And so, as a result of
Mhm.
that backdrop and that view, you're always looking for what could I do? Do I want to go to cash? Do I want to stay with stocks? And so, I still think there's good companies that I want to own, even though I expect to sell off in the second half. So I'm buying this fire insurance. That'll go up a lot and protect the portfolio, but also give me some cash that I can use to buy stocks that are cheaper in the next half. So I've bought those puts, and hopefully we can find a unique way to simplify that. Um,
Gotcha.
yeah. The other thing that I think that does well is long bonds. Gold, I think has is very well positioned for the next setup. And some of the consumer staple names, we've talked about a few things. Obviously, we do the weekly roundup for clients, so we talk about the individual names. At that point, it was a classic example of one, which is Clorox, which is a consumer discretionary name, which had a great setup a couple of weeks ago. It was trading down about 25% year to date, 4.5% dividend, with my view that the next phase of the cycle is going to be good for consumer discretionary. Typically, this is a name that would perform well in the next setup. So those are kind of the things that I expect to do well in the back half of this year. And so I think that's kind of my thinking around what I expect to do well. I think probably the last piece that I'd want to talk about is why I expect that to be the case. In the first start of the year, I always go in deep into charts and macro and get into talking in great detail about that. This one I thought we'd do a little bit shorter, but hit kind of the key points, what worked, what didn't, what I expect to happen. And then I did want to wrap a bit with a little bit of talk around what I expect the macro backdrop to look like. And so, maybe I'll pop up just a couple of 2 slides here that can show kind of my view around like why I expect this to happen this way, if that makes sense to you, Scott.
Yeah, for
All
sure.
right,
I think also at the end we should tack on some of our plans that we have for customer service as well.
definitely.
So that upgrade that we have planned. So we'll tack that on at the end as well.
Yeah, that sounds good. Sounds good.
All right, whenever you're ready.
Okay, let me know when you can see it.
While you're doing that, I'm also going to. They just upgraded our platform here. They added sounds, so I'm going to try the clapping sound here.
I can't hear it. Can you?
Yeah, I can hear it.
Oh, okay, interesting.
Can you hear that or no?
I can't hear it, but maybe it'll come out onto the
Oh,
recording. That'd be great.
it probably will. So everybody just clapped for your chart you have
That's
here.
good. Love the charts.
So let's go.
Yeah.
We'll try a few of these as we
Yeah.
go. All right.
Yeah, so I've been trying to kind of get this kind of vernacular so people kind of understand a little bit about how I think about the macroeconomic environment. And there's really kind of 2 key inputs that go into every decision making and what happens to the economy. The first is what's happening to growth, or GDP, which is gross domestic product. And the second one is inflation. So these are kind of the 2 inputs that really play a part into what happens to uh, every single asset class in the world. What's happening to these 2 things in every part of the world? So, I've used Hedgeye and Darius Dale's kind of spun off, and he has his own corporation now that does this research and provides it out to us. And so I thought I'd send this out just as a simplistic, trying to show you that really kind of the inputs that are the most interesting is GDP and inflation, so growth and inflation. And so if we look at this framework, there's a couple of things that are kind of most interesting when I look at it. Is it's really the direction around how we see those 2 things playing out. And right now, what it looks like with the current setup is we have growth continuing to accelerate until August, and inflation continuing to accelerate until August, so another couple of weeks, we'll say. And then as we get into the next phase of it, we see the direction or the rate of change of GDP start to decelerate. And so as we look at this section here, it shows kind of the direction of GDP change. And so we get a negative rate of change. So we're going from one level to the next level, but the direction is down. And as a result of that direction slowing, you tend to get equities start to not like that period. And so we call that either quad 4, which we've talked about, or deflation as Darius refers to it. So that's typically not good for broad equities. And the other input, of course, is CPI. So this is headline CPI. And again, the expectation is we start to see inflation slow, continue to stay elevated but slow. And so, commodities, high beta stocks, like high beta means you get more volatility towards the equity market. So these things tend to do poorly in a slowing environment. And so I pulled out a snapshot of the United States. We can look at the whole world, and I do when I'm making decisions within portfolios, but really this is the US. The backdrop is we're expecting growth to slow, inflation to slow, and the deceleration isn't going to be like 2020, where we saw deceleration of GDP and inflation at the clip that oil went to negative number. It's just going to be a gradual deceleration, maybe a 1 or 2% deceleration, but all assets price off what's coming in front of us, not what's already happened. And so this is really kind of my view and backdrop around how that's going to look. And so there's just one other slide that I did want to show. So can you see that, Scott?
Yep.
Yeah.
Yep.
So this one kind of talks a little bit about what the central bank's done over the years. And so, I think this kind of bout of volatility in the market has all started with Powell. Powell came out and said he's going to potentially raise interest rates in 2 years. And it's a lot, we've seen Bernanke come out and do it. In this example here, we've seen Yellen do it, and Greenspan over the years. So they tend to always make the wrong decision at the wrong time. And so they're starting to talk about tightening. And as a result of them starting to talk about tightening, it spooked the market. And so if we look at, this is a picture of what happened in the summer of 2010. We saw, this is the S&P 500. And so we saw the S&P 500, sell off about 16% through that period here. And so as I look at it, history doesn't exactly repeat itself, but it does rhyme. And so some of the similarities of what happened in 2010 are playing out today. Additionally, if we look at what's happened to the US 10-year, we've seen it come down about 20% off its highs, like 176 to kind of 130, 140. So, if you look at kind of those two things together, it gives you kind of that view that the bond market's saying, we probably have some risk ahead for equities. Additionally, the central bank is signaling that they're going to tighten into some risk. So, it's not one or the other, but it's certainly something that gives me some cause to think about. This particular setup likely plays out, and so it makes me think about risk management within the portfolios. And this wasn't something we talked about in great detail in the start of this year because I didn't think we needed a ton of risk management on, but now I think it's certainly important. So wanted to talk a little bit about the macro on that.
Okay. Great. Great job.
So I think the last piece I'd like to hit on that before we go in to talk about some of the things we're planning to roll out is, because we saw kind of that crypto sell-off like we saw earlier this year, and the timing didn't exactly line up with when I expected it. I think we've seen a pretty good base building in here with Bitcoin, Ethereum, and some of the others, but those would be the primary ones. And so because all of the leverage has come out of the system already, one of those huge risk parameters that I would have expected to be the setup today, had you asked me in January, a lot of that's gone away. So I think that the downside of it is actually quite a bit more limited than I would have expected it to be at this point. So yeah, right. I think some of that's already come out of the system.
Gotcha. Yeah, I agree with that. I really do. I really do. We've talked at length about that, obviously.
Yes.
Just about every day.
Yes.
Okay, well, that's good. I think that gives people a good snapshot of where we're at on that side of the business, which is obviously the most important part. I mean, that's the number one thing that we're here for, right? Is to help make people money and secure their financial future. So I think you're doing a great job with that. And I think that goes back to like really what one of our new branding tagline this year is, built for growth and prepared for risk. And that's really all the mentality and everything that we're building this new brand around is not only that from an investing standpoint and view, right? It's also how we're building the organization. I mean, obviously, Ben's best suited to spend all of his time focused on those things, right? And he's brought me in to kind of run all the other parts of it, build the brand and develop the customer service and whatnot. And we think we've really started to address some of those things.
Mm-hmm.
I think we just had some growing pains in the first half of the year from
Sure.
the standpoint of when we made the move
Mm-hmm.
and trying to learn the new systems of the new bank and whatnot. But our mandate is to do just that. So the number one thing is obviously to focus on the investment side, right? To manage everybody's portfolios, to make sure that they're growing and we take as little risk as possible. But then the next level down is from the customer service. Like what we've recognized is that, for us to really succeed, you guys have to, number one, have access to us as quick as possible. And that's the number one thing that we identified and the number one thing that we're working on right now, because the best thing we can do for you is answer your questions and get back to you and perform your transactions as quickly as possible. The way that it stands right now, we get hundreds of emails every day and we process dozens of transactions a day. And that's why we've brought in more manpower. So what we did is we've kind of spent the last 6 months assessing what we have. Okay, you know what, we're a little slow getting back to people. We need, and the only way that we can do it is to bring in more people. So we've done that. We got to get that person trained up. But that's the number two thing, is to get back to people as quickly as possible. So that's going to be also focus for the second half of the year. And the number three, I think, is to start introducing, like we've done a really good job, I think, with putting more content on and introducing people with the interviews that we've done. So we're going to do definitely more of that, producing more content that's of value to the client, not just helping promote what we do. That's tertiary to what we're doing, but to really bring value. So we're going to bring some I don't want to say lower level, because I think that could be demeaning to some people, but some more understandable things, some more practical tactics for people, whether it be in planning or insurance or things that they should be thinking about, or estate planning. I think that's something we definitely got to explore more.
Certainly.
So we're going to do that. And then the other thing is also developing partnerships with people and create certain standards. So when people need a lawyer, for example, for estate planning, we have somebody that we've vetted. So we have a handful of people who've already started to vet. We've started to introduce some people to kind of see how those relationships went. So we started kind of teasing this in the first half that we were going to do this, and we've done kind of a beta program with some people. And we're going to continue that, so that, hey, you need a realtor, or you need a mortgage broker, or anything in the financial realm, accountant, bookkeeper, whatever it is, right? We've grown those trusted relationships. And I think that's a huge value to people that can't be overstated. So as you can see, we have a lot of those things. We've already started the wheels turning on them, but I think it's going to make a huge difference from the customer service side. Not only that, it's going to let Ben do what he does best, is help make people money and protect your money as well.
Awesome.
Anything to add to that? Anything I forgot from that standpoint?
Yeah, no, I think that's great. That's a good summary. I think that's definitely our priority in the second half. We've acknowledged it, and we're working towards that. I mean, it's going to result in some things that we're gonna roll out. And to your point, just about education piece, some of the feedback that we've got in the first half of this year is maybe we can find some ways to make some of these pieces a little more bite-sized, like show us how to learn about a particular thing that you talk about in the podcast. So we're definitely going to plan to do some of that in the second half.
Definitely. And even more specifically, because we are rolling it out soon now that we have Joy on the team too. We're working to get one central email where all of your requests can come into, and then Joy will manage those tasks. We found that that's going to be a way that we can speed up processing everything. Same thing with the phone number. We're going to have one central number. I think it's going to be an 800 number that everybody can call into, and you'll always be able to get somebody. So if Joy's not available, it'll go to me, and if I'm not available, it'll go to Ben. And if for whatever reason all three of us available, maybe you'll get a voicemail, but we'll get back to you hopefully within an hour or so. So that's kind of where we're going. I know we're going to get there. We've kind of achieved all the goals that we set out to in the first half. So we're super excited to take you guys with us on this ride.
Awesome.
That's it. What else you got, man?
That's it. I think
I can't believe it's already been first half of the
I
year.
know it is hard to believe. Time flies. It's been really one of the most interesting market years to start the year that I've ever seen in the business, from
Mhm.
a sector changing, what's working, what's not. So, I'd expect the second half to continue to be quite different and unique. So you got to continue to evolve the process. So I'm excited about what the next couple of quarters look like.
Yeah, for sure. Yeah, no, I'm super excited because there's tons of opportunity in the market too, right? Because I think with a lot of advisors too, everybody just kind of steps. Well, I've noticed in the industry in general, everybody just sits back and waits to see
Yeah,
what everybody else is going to do.
right.
So it creates a lot of first mover opportunities, right? And that's
Yeah,
definitely who we are. So
yeah, yeah,
cool.
yeah.
Well, thanks for joining us on the our first semi-annual review at National Bank Financial.
Definitely. Good. Awesome.
Okay,
Cheers,
we'll
great.
see you next time.
Take care.